Question 39, Casasophia. So this question involves not only your exchange rate risk management, it also involves net present value, right? So this is a very interesting question, and it's not very easy also. It is a complicated question. It has a lot of things to do. So make sure that you understand each step in this video, right? Now, before go to the case study, first I will start reading the requirements. You can see that we have given the 4-month forward, spot, and then we have futures, we have options, we also have swap in this question. So we have so many things in this question to do, and also net present value, right? Part A, there are only two requirements. A, advise Casasophia company on and recommend an appropriate hedging strategy for US dollar income. It is due to receive in 4 months. Include all relevant calculations. So here it is a US dollar income and it is for 4 months, and appropriate hedging strategy you need to recommend, advise and recommend. B, given that case, okay, so this type of question you are very familiar with because all the time we have been recommending an appropriate hedging strategy for a foreign currency income or a payment. Now part B, given that Casasophia agrees to the local bank's offer of the swap. So this is about swap. Calculate the net present value of the project. Now do you see how the two part of the syllabus is linked in one question? One is your advanced risk management, which is syllabus E. The other one is syllabus B, which is your net present value, right? Your investment appraisal question. So in 6 months time, in euro, discuss whether the swap would be beneficial or not. You also need to discuss whether swap is beneficial or not. 10 marks, right? See, when there are so many requirements, when it's for 4 marks, 5 marks, 3 marks, 6 marks, right? Marks are less, but requirements are many. It's easy. Those type of questions is easy to handle. Why? Because each question specifically you know where to touch. From which part of the case you know where to take information. But the problem comes when only very few requirements are there, 1 or 2 requirements, and the marks is very high. Like this question, 15 marks and 10 marks. The requirement might look less, but you have to do so much of work. And what to work, what are the steps to include, will break your head off. And also when you read also, you need to, read so much of information and retaining all the information. It's a great task. But that's why keep on reading more and more and more and more questions. By the time you keep on doing many questions, at the end or in the middle, maybe somewhere, when you read, okay, the sentences, you automatically, your mind will read the next sentence. You will know what is the next sentence or how it will look like, right? The first few times when you're doing it, it will be a shock. You'll be like, first paragraph is saying something else, second paragraph is talking about something else. That link you will not understand that, or maybe you will not get that link. But as you keep on reading the questions, you will understand that pattern. There is a pattern, there's a trend of asking a question. Okay, so go through that. And now we are going to go through this case study, which is Casasophia, based in an European country that uses euro, constructs and maintains advanced energy efficient commercial properties around the world. So it uses euro. Okay, let me highlight this. It uses euro. Okay, it uses euro. Okay, because you also have to deal in euros. Your swap and all, your net present value and all, you have to keep in euros. Now, it has just completed a major project in US and is due to receive the final payment of US 20 million in 4 months. So, it is going to receive US dollar in 4 months. Very important. Because this is the amount you have to hedge using various hedging strategies, and you have to say which one is the best. So, part A is easy, but part B requires a lot of extra work. So Casasophia is planning to commence a major construction and maintenance project in Mozambique, a small African country. Now you see, they are going to have this project in a different country in 6 months' time. Okay. Now, This government owned project is expected to last for 3 years, during which time Casasophia will complete the construction. It's going to last for how many years? 3 years. Okay. And the Casasophia will complete the construction of state-of-the-art energy efficient properties and provide training to a local Mezabian company in maintaining the properties. The carbon neutral status of the building project has attracted some grant funding from the European Union, and this funds will be provided to the Mezabian government in Mezabian shillings. Okay, so and in the one hand you are having a receipt of US dollar, and the other hand you are going to attract grant not in US dollar, in some other currency. So here in this question there are not just one to one, there are one to many. There are three currencies involved here. One is euro, one is US dollar, one is Mezabian shillings, MSHS. So this is where the complexity come. Okay, complexity comes. So it is this, and the grant. Now, Casasophia intends to finance the project using US dollar 20 million. See how it's going to receive the fund that investment by using the 20 million US dollar which they are going to receive from their US customer. Okay, it is due to receive and borrow the rest through a euro loan. So the rest they are going to borrow through a euro loan. It is intended that US receipts will be converted into euro and invested in short-dated treasury bills until they are required. This funds plus the loan will be converted into, okay, this funds, the 20 million plus that loan will be converted into MSH at the date required at the spot rate at that time. Now, Mezabia's government requires Casasophia to deposit how much? This much million. This much will be deposited by Casasophia. It needs for the project with Mezabia's central bank at the commencement of the project. In return, Casasophia will receive a fixed sum. So in return, how much Casasophia is receiving? Fixed sum of 1.5 after tax at the end of each year for a period of 3 years. 1.5, 1.5, 1.5. Neither of this amount is subject to inflationary increases. The relevant risk-adjusted discount rate for the project is, so the risk-adjusted discount rate is 12%. Why it is given to you? Because you need to find net present value also in part B. Now, come to your exchange rate. Spot, forward has been given, right? Now, which rate? We'll see later. Future has been given. The size will always be the same, the option and the contract size, right? So 2-month expiry and 5-month expiry. You have to choose which one. And for options, you have to choose whether call or put, and 2-month or 5-month, and which exercise price, right? Here they didn't say which exercise price. You have to do under both the exercise price. Let's see. Now you have been given the rates. Casasophia local government base rate, Mezabia government base rate, and yield on short date euro treasury bills. Assume a 360-day year. Now, Mazabia's current annual inflation rate is 9.7% and is expected to remain at this level for the next 6 months. However, after that, there's a considerable uncertainty about future, and annual level of inflation could be anywhere between 5 and 15% for the next few years, right? After that, 3 years. Now, the country where Casasophia is based is expected to have a stable level of inflation at 1.2% per year for the foreseeable future, right? A local bank in Mozambique has offered Casasophia the opportunity to swap the annual income of, see, Casasophia is going to receive this 1.5 million annual income, right? So now Mozambique is offering, the local bank in Mozambique is offering a swap to swap this income in the next 3 years for euros. Okay. At the estimated annual forward rate based on the current government base rates. So the estimated forward rate based on the current government base rates. Now, first we have to look at which hedging strategy. So first we are going to do only the hedging part, not the net present value, right? The marking scheme and the top tips by the examiner and all we are going to cover at the end of this video. So first we are going to start with the forward, right? Because forward is the easiest. It is easier to start with hedging strategies, a receipt. So the company will receive US dollar, therefore we use the rate. Which rate you have to use? You are receiving. Okay, so let's go to forward, the 4-month forward, right? You have to 1.3588 or 1.3623. You are going to receive US dollar, right? That means you have to see the this currency, euro. You are receiving means you have to sell dollar and you have to buy euro. You have to buy euro means you will buy euro at what rate? Bank is selling you a euro at this rate, the higher rate, 1.3623. Therefore, you will select 1.3623. Right? See this. So you need to convert this into euro, right? Divide it by 20 million and the rate you are getting. Now the hedge fixes the rate at this. This rate is legally binding, right? This you have to talk about, right? Forward means what? It is binding. It is fixed. That rate is fixed. Now going to future. Okay. You need to say. You need to write this. What is it? Forward contract, future contract, option contract. Okay. Now future contract. Okay, now future contract will go to future contract. Now which one you have going to say? It's a 4 month. Are you going to go for the 2 month expiry or 5 month expiry? Of course you cannot go for the 2 month expiry. It is expired. It will be less because it is our hedging period is 4 month. So we cannot go for a 2 month expiry. We need for the 5 month expiry. So we have to choose the second one, 1.3698. So we are going to go for the 5 month expiry. That you need to write it. A 2 month contract is too short for the required hedge period. Therefore, we must use a 5 month contract. The contract will be closed out in 4 months' time. You need to write this statement. And number of contracts have to find. The contract size is 125,000, right? That is in euro. So this euro you have already got from here. The $20 million you need to convert into euro. So how you are going to convert that? 20 divided by the future price, 1.3698, right? You shall get 14,624. Right? 20. There is a hold on. Oh wait, this 14 64,159. Okay, this 20. Okay, so this amount I guess it's wrong, right? Because it is 14,600,671, right? Because if you're taking 20 million, it will be divided by 1.3698. So this amount is wrong here. This amount, it will be 146,00671, right? Or 672, you can say, rounding up. This divide by 125,000. Okay, how you are getting it? Because it will be 20 million, right? Wait, this will be 20 million divided by the future price, which is 1.3698. and when you divide it, you will be getting 117 contracts. You will be getting 117 contracts. You're rounding up, right? Now, you can estimate the future rate using the 5-month period, the spot, and the 4-month forward. You can estimate the number of contracts needed as. Okay. This. Okay, so there is another method maybe. So that's how they have got this one. But we are not. But we have been learning it this way. So this is the correct way, the second way, right? So this is the amount which we got. 14601. They have rounded up again. Okay, they have rounded up this value 146000672. Right? So if you do it, you will be getting 107 contracts only. So it's better that you use the normal way. We divide it by the future price, the 20 million, and divide it by 125,000 to get the number of contracts, which is 117 contracts. It is 116 point something and we're rounding out to 117. Now let's go to the outcome. Whenever future and option is there, we go to the outcome for the future and outcome in the spot market. Same for the option. Outcome in the option, outcome in the net outcome. Okay, so now first we are starting the outcome in future. For that, we need to decide the basis risk. Once we decide the basis, we know what is the closing future price. We have to estimate the closing future price always when a future is given to you. So the outcome will depend on the spot and the future prices can be estimated as follows. This is the method. This table has to be there. Always you have to put this table to calculate the closing future price now and the 4 months. Okay, so there will be two columns, now and the 4 months. So 5-month future price is this. This is the opening future price that is given to in your requirement. After that, this is your spot rate, 1.3618. We'll go and check the spot rate, right? Because future minus spot is your basis. For that, you have to calculate. So your spot, exactly this one, 1.3618. We have been using this rate in the forward. So we have to use this one in the spot. It cannot be that we are using this rate here and we are using this rate. Okay, it has to be in the same line. So it is 1.36. Now, the basis. The difference, if you are taking the difference, it will be this. The 5-month future minus the spot now. And into 1 over 5. Why 1 over 5? Because the hedging period is for 4 months. We have taken a 5-month future so that 1 month we are not, in the future there's a basis risk because we are only hedging it for 4 months. That 1 month we are not hedging, that extra 1 month, because we have taken a 5-month future. So 1 over 5. Only 1 month out of the total 5 is for basis risk and it will be 0.0016. Now, okay. So how do you get you have to get back. So this is the balance. Now you are writing this here. Now you are going upwards. Now you are going upwards. The spot rate, they are saying it is assumed 1.3698. This is exactly the same rate they have taken here. They are bringing here. So the 5-month future, right here, they didn't tell you any spot rate, right? They haven't told you that at this date, this is the spot rate or something like that. So we are assuming that future price, opening future price is the spot rate in the 4 months time. So the same, okay, so this 5-month future for now, we are taking it as the spot rate and the 4 months, it is assumed, okay, because they haven't been given any spot rate, okay, after 4 months that this is the spot rate. If they have clearly mentioned that this is the spot rate after 4 months, is okay, through that we can calculate the future. So now we are working like this. We are adding this to get this. We are adding spot rate plus basis to get 5-month future. And that is the balance. Okay, so this is the way of working the closing future price 1.3714. Assuming that the spot rate in 4 months is the same as the future rate, the outcome will be this. If you are using a spot rate which is the same, if you are taking it from the future rate, you have to write this statement because sometimes they give you the spot rate. But in this question, it is not given, so we are assuming. So when you are assuming also, don't think that the examiner will know it. Okay, because they haven't given, so it is assumed. No, you have to write this assumption. Wherever you can state assumptions, you have to state assumptions, even if it's most obvious. You're getting marks for it. Okay, so spot rate in 4 months is the same as future rate. Okay, now based on that, now we are assuming how this is the actual That means in the spot what's happening. Okay, so that and the future together, we want to calculate our net outcome under future. So what is, even for options also you have to do the actual, the spot market and the options. Okay, and this is in thousand. Okay, this is in dollar by the way, and this is in euro because everything needs to be converted in euro at the end. Keep it in euro because dollar is a foreign currency, right? Assume spot in 4 months time, so we are assuming that this is the spot rate. Now we have already calculated this in the beginning itself, 20 million divided by 1.3698, so we are getting this euros. Okay, 14,601,000. Now, and here they have told, see, because here alternative assumptions are possible, that's why it's very important that you write the assumptions, because some candidates might have some other assumption, they might use some other figure, right? Still they are going to get marks. Still they are going to get marks if they have stated assumptions and used that number, they are going to get marks. So there is, it's not about right and wrong, it's about what assumptions you are making, and based on that what is your action. Now let's go to future. So future, we know the opening price also, opening price also. Now we have calculated the closing price also. The reason we calculate the closing future price is always to find the gain or the loss in the future market. Gain or the loss. Now opening is 1.3698, closing is, we have calculated, let's go above here, 1 point, the balance 1.3714. The difference if you take, right, it is this, right? It is in negative because your opening is less than your closing, right? But it is a profit. It is a profit. Even though it's a negative, you're showing negative. Okay, it's no need that you don't have to show negative actually, because it's not a loss. It's a profit because you're buying at a lower price, selling at a higher price, right? Here they have shown bracket because maybe they are deducting like this, 1.3698 minus 1.37, it comes a negative number, but actually it's a profit. Okay, so don't get confused with that here they are writing in bracket and down they are writing profit. It is a profit only, you don't have to write bracket. Okay, keep it as positive. Okay, so now this thing, buying and selling, how do you know that in the opening you're buying? See, in the opening if you are buying, you already have to decide what you are doing in the opening, because closing is of course the opposite of it. If you are buying in the opening, you are selling in the closing. If you are selling in the opening, you are buying in the closing. It will always be opposite. It cannot be buy or sell. It will be buy sell or sell buy. So first you have to decide in the opening you are buying or not. Here they are saying it's buying. We'll see how. Why it is buying. Okay, that is a future. Okay, look at the contract size in future and option also. Same goes for options. Whatever you do in future, same apply for option also. Okay, we are receiving dollar. Okay, that means we are selling dollar and we are buying euros. We are buying euros. You see, we are buying euros. That's why we are buying. Okay, so we are buying and profit is 17. Okay, how they got profit as 17? It is quite confusing, right? Because they haven't shown you the method how it is 17. How it is 17? Hmm? Okay, so here also they have what? They have rounded up. How they have got this profit? It's here. This is the way they have got that 17. So 117 is number of contract multiplied by contract size 125,000, and then this the profit 0.0016. The whole thing you need to divide it by the spot rate because you need to convert into euros. So in euros you are having 7. Actually you are having something 17,082 okay, 786 maybe, right? If you are writing in millions, but they are rounding up. So that's why they are writing euro 17 only. 17 million. Okay. Next. Next, what is next? They are writing this, and then using this, they are getting the effective rate, which is 1.3682. Okay, basically alternative shortcut approach. Okay, so if you want to get effective rate, okay, this is a shortcut approach. This can be applied in your exam. Maybe the first one you did, it's a long way, but opening future price minus closing. So opening future price is this, closing is this, effective rate is 1.369. If you don't want to do it like this, you can do it like this line itself is enough. Opening future minus closing basis, you will get your effective rate. So in that case, you don't have to do all this 14,618, 20 million, divide by 14,681 to get the effective rate, right? Now, basically this 14,618, right? It is what? It is your total profit. It is your outcome, your net outcome, I would say, right? Because they are adding the 17. I'm sorry, 17,000. Okay. Sorry, there is some mistake. This is in thousands, right? So this, it will be 14, okay, 601 in thousands. I'm cutting off the 3,000s plus 17,000. Okay, so this will be, it will be like this if you add, because this is in thousands. Okay, this is in thousands. So then it becomes 14,618. This one. This is why it's very important, the zeros and all, right? This is 14,601,000. This is 17,000, right? It is not 17 million, because if you add it 17 plus 14,601, it becomes a very big number, which is a wrong number, because it is in thousands and this is in also thousands. Okay. In other words, if I cut both the thousands, the number will be like this only, right? So 14,618, that is a net outcome. Next, comment, you have to talk, you are getting marks. First you calculate, then comment, calculate, then comment, right? So the future rate is worse than the forward rate. Future contracts are marked to market on a daily basis and require margin payments, right? These are some features of future. Whenever you're doing this, you need to know some features. One of the feature of future is market to market on a daily basis. Margin payment is required. As with forward, future contract fix the rate and are legally binding. Okay, forward are legal binding and it fixed the rate. Now we'll see why future rate is worse than forward rate. What was the forward rate? Let's go up. It was, okay, 1.3623, or we can just check the receipt. It is 14,681. 14,681. Here it is 14,618. So you can see that forward is better than future. Now let's go to options. With options, the holder has the right but not the obligation to exercise the option. That is, option will be exercised if it is beneficial to holder. However, there's a premium to be paid for this flexibility, making options more expensive than futures and forward to protect itself against a weakening US dollar. Okay. How to protect itself against weakening US dollar? Please check my other videos. Question 40 or yeah, question 40, and then I think one more I have explained. I forgot the question number, but there also I explained how weakening and appreciating, how you will understand whether it's weakening and not. Casasophia will purchase euro call options. It's a call option. Because in future, what were we doing? We were buying. We were buying euro. So buying euro, and also option is priced in euro, contract size in euro. So that's why we have to buy euro. That means we have to go for the call option. Exercise price, with both exercise price you have to know, because they haven't told which exercise price to use. So with exercise price 1.36, what is the receipt? Divided by 20 million divided by 1.36, this is the what? Receipt. Now this you need to divide by further 125,000 to get number of contracts. 117 round down. Okay, 117. So with 117 contracts, okay, because there's a decimal here. Whenever there's a decimal, you will understand there's a under hedging or over hedging. In this case, it will be under hedging. How will you know? Because it is 117.6, but you are using less contract. Lesser contract you are using, it will be under hedged. More contract you are using, it is over hedged. This will be under hedged. That means the remaining portion you need to hedge using forward. Because you are using that zero point 0.6 contract, you are not using 170, you are using less than required. So how do you know that difference? The way is the number of contracts you have taken into the contract size. 125 into 117, so this is in euro. Now you need to convert into dollar, because you know 20 million is the dollar. So how much you are not hedging from that 20 million? That's why you need to convert this again into dollar, right? And this the okay, here amount not hedged. So 20, from the 20 million you are minusing the amount already hedged using option. It is this 117 into 125, which is 14625 into 1.36, multiply by the exercise price, so that you get in terms of dollar. Because both of this has to be in dollar. Okay, because this 20 million is in dollar, so this portion also has to be in dollar. It cannot be that dollar minus euro. You cannot do it. Most of you forget to multiply by 1.36, that is your exercise price. You forget to multiply and then you keep it in euro, and then you deduct dollar minus euro amount, which is completely wrong. Check your currency. It is important that you check your currency, both has to be in dollar. That's why you're multiplying again by the exercise price. Don't leave it in euro. Don't deduct this. Most of you take this figure and started minusing it from 20 million, which is absolutely wrong. Okay, next, this is premium payable. Premium payable. Okay, so first 117 into 125, it is in what? Euro. Then you need to multiply by this 0.228. We'll see how. Go to that table, call 5-month expiry 1.36. It is 2.8. That means 2.8 divided by 100. Always whenever you take premium, it will be divided by 100 only. So 2.8 divided by 100, you are getting 0.028. Okay, multiply it. And the premium which you are getting, this is in dollar. Even though these are in euro, still this is in dollar, so your premium becomes in dollar. Now you need to convert this back to euro. So the main problem with this is converting and then again changing. You need to keep everything in euro at the end. So 409,500 divided by 1.3585. What is this 1.3585? That is the spot rate. Spot rate, what spot rate? Not the spot rate which you used before. No. See, premium you have to pay irrespective of whether you exercise it or not. For premium, see, you took the spot rate before, it was a receipt, but premium, remember, it's a payment. So since it's a payment, okay, you have to now what? Before you were buying euro, okay, now you have to sell euro. You have to sell euro and buy dollar. It's a payment. So you have to sell, means bank is buying. So this is the rate. This is the rate. That's why when you come to premium, be very careful. Don't take the spot rate which you have been using it before. Always check, go to the spot rate and see it's a premium, it's a payment. Premium, it's a payment. In this case, it's a payment in premium because we are buying the option. So use the spot rate, divided it and keep it in dollar. Okay. And then you are getting that premium. Okay. So this amount can be hedged using a 4-month forward contract as follows. Okay. Okay, yeah, the remaining, the amount which is not hedged will be always hedged using a forward. So what is that amount? This 110. bring down here, hedge it using the forward rate. What was the 4-month forward rate? 1.3623 only. We'll go to the forward and see that that was the rate we used or not. Yes, exactly 1.3623. You see, always go up and check if you're having a doubt. Don't be in a doubt. You have to be 100% confident and move ahead. So that forward rate you divide and this amount. Now the total receipt, even in option also, you have to find what is the total receipt. So the total receipt will be how much? This is a receipt. Don't forget, payment is different, receipt is different, way you trade is different. So how much you are receiving? 14,625 plus, sorry, minus the premium. Premium is deduction. You check everything is in euro plus this. Why you are adding it? Because this is receipt, my dear friends. This is not payment. Usually we deduct it, but this is receipt. When you hedge it is and it's under hedged. That means more if you are hedging using forward, you are getting more payment. So this also has to be added. And this is 14,404. Right? It is less than. We saw that forward was the best. Let's see it with the future. 14,404. No. Sorry, where were our feature? Our feature was here. No. It is even worse. It is even worse using this exercise price. Okay, but on that we'll comment later. Now we are going to use this exercise price. The procedures are same. So I'm not going to spend so much of time. We can rush through. Receipt we know. Number of contract is also the same way here. 115.9. But we have to round down. Okay, not round up. We have to take less contract. Otherwise see, we can buy 116 contract also. You might be arguing because it is very close to 116. But what about the premium for that 0.9, for that 0.1? Okay, we have to still pay a very huge amount premium. We don't want to do that. So it is always round down, not round up. That's why 115 contracts. Now next, all we know, same procedure. Okay, premium payable using that exercise price is premium. Okay, the same way, everything is same. Here also amount will not be hedged. It will be under hedged. Okay, we know how to calculate. All the step will be similar to the before exercise price. So I'm not going to go through all this. Okay, same way total receipt minus premium, add that from the forward. Here you are seeing 1428. This is even worse, worse than all. Now you can write. Okay, so the receipt from either of the options are considerably lower than those from either futures or forward. This you need to write. See, very briefly you are writing. You're not saying this is increasing, this is less, that is less, this is more. No, not one by one. Overall you have to write like this. Okay, that option, both the option is worse than futures and forward. One simple line, alas. And this is primarily, now you have to say why it is high. Just saying option is worse is not enough. This is primarily due to premiums payable to secure the flexibility that option offer. The US dollar would have to move significantly against the euro to allow Casasophia to cover the cost of premium. That means, what does it mean? What does this line means? Most of you might have not understood it properly, misinterpreted. US dollar significantly against euro means it is moving in the favor. Yeah, so they can take advantage. Okay, in option you can take that advantage if interest rate goes in your favor. If it does not go against your favor, you can at least hedge, right? So if it goes with, right, in your favor, you can also take advantage. That cost, okay, it will be covered. The cost of the premium will be covered by that benefit. Now the conclusion has to be there all the time. They told advise and recommend. That means conclusion only they are saying which one. So based on calculation above, it is recommended that Casasophia uses forward contract. Here it is easy to say forward contract. The reason is the difference between future and forward is very big. When the difference is very big, it's easy to say that choose one. The problem comes when the difference is very minor. It's not too much difference significant. In that case, you say that you can choose any one of this. It depends on the company's director or finance director, whatever it is like this. So something like this you can write. Here they are saying forward contract to hedge against US depreciating against euro. Whether it's depreciating or appreciating, you have to work it out. I have shown in the previous videos, right? Just go through those videos in my currency risk where I've been going explaining how, because I've been repeating this over and over again, and I'm like done with it. I'm like so done with it. Okay. So use depreciation against euro in order to maximize the receipt. Okay. The company should be aware that once the contract is agreed, price is fixed and is legally binding. This you need to write forward, right? In addition, there's no formal exchange for forward, thus giving rise to default risk. You need to talk about disadvantages as well, even if you're saying forward. So there's no formal exchange, rise to default risk. Now let's go to part B, the very interesting question, right? This question, the good thing is it's too much of calculations. So it's a good question that you should attempt, and you should see this video throughout the end, because theory part is very less. Your calculation part is too much. Part B is where your complication arrives, because this is not like your general net present value where we're starting with year 0 or year 1. This question is starting from half year, that means from 6 months onwards. So the way you calculate 6 plus 1 year, 1.5 year, 2.5 year, 3.5 year, the complication comes there itself. That is this is the difficulty level. Okay, so now expected forward rate using interest rate parity. See, forward and interest goes together, that you have to understand. Forward using interest rate parity. Why interest rate parity? Why not any other method? You are given the interest rate. You have been given the interest rate of the two countries. We know the spot rate. So based on that, we can calculate for each year. Why are we using this? Because to calculate the exchange rate for each 3 years, we have to convert back to our home country. It is an international net present value, right? For half year, it is starting from half year. How do you know? Right? Your question is, how do you know? Go through the case study. Okay. Okay. Maintenance project Mezabas, read the second paragraph. Is planned to commence a major construction and maintenance project Mezabas Small Africa in 6 months' time. In 6 months' time, starting from 6 months onwards, whenever they say. In 6 months' time, in 10 months' time, in year 0, they would say, okay, at the end of year 0, at the end of year 1. They specifically say like that. When is the starting date? Okay. So this is 6 months' time. Now, the interest rates are here. This. Okay. Zabia and Casasophia, 10.8, 2.2. Okay. Very interesting question. I just love this such type of question, which makes you crazy, which makes you think. I just love this type of questions. Now, okay, as you can see, first it is half year. That is number one. Now the second reason is problem is, how do you predict for the half year? It's easy for 1 year. You are already given for 1 year. How do you do half year? Reason is simple. First find for 1 year. Then you can do for 6 months. We'll see how to do for 6 months. But first we'll do for the 1 year. 1 whole year. Okay. That is the spot rate we have to use. Yahoo. Okay. So it is okay. Yes. You have to use what? Euro and which currency? I even forgot the name of the Mazabian shillings. So it is this, okay. Out of this, which one? 116, 128. 160 or 128. It is given as 128, but you need to know the reason why it is 128. Because when you're studying, you know this is why it is 128. Okay. Where is it? It's 128 here. If you can see here, it is 128 only. Based on that only, you are multiplying by the interest rate. But why 128? We are buying euros. We are buying euros. Why we are buying euros? We are receiving what? For the next 3 years, what are we receiving? We are receiving in Mazabian shillings. Since we are receiving, we are selling that currency and we are buying euro. Since we are buying euro, bank is selling at this rate, 128. Because the base currency, euro. So we are buying euro. We are selling Mazapian shillings. We are buying euro. We are buying euro at a higher rate because bank sells at a higher rate, and for us it's a loss. For the bank it's a profit. So it is 128. Okay, that much you understood. Now comes the interest rate. Here you can see it will be 10.8% and 2.2%. Right? It is this two rate 10.8 because it is the overseas currency, overseas interest rate. So it will be on the numerator 10.8 divided by the base currency, that is 2.2. So that's why it is into 10.8 divided by 2.2. For the first year, if you have found out, right, it is 138.77. Now how do you find for the half year? So half year, this is your 1 year's rate, okay, plus that plus, okay. Of course, your half year's rate will be less than that 1 year rate. It will be less than 138.77. So it is 128, okay, plus this one, this 138 which you have just calculated minus 128. Divide by 2. So that plus 128, it is 133.38. Whenever a question comes like this, now you know how to calculate for the 6 months. Now from that here onwards, keep on adding 1 year. So it will be 1.5 year, 2.5 year, 3.5 year. So on this 133.38, keep on multiplying 10.8 divided by 2.2%. Okay, so keep on doing that. All these are same. And then you get for 3.5 year. 3.5 year means actually from here to here it is for 3 years only, right? Because this is basically your year 0, then it comes, this is your year 1, then this is your year 2, because you're starting from 6 months, not from year 0. This is your year 3. Okay, now net present valuation. Note that year 1 actually means 1.5. From now, as project starts in 6 months time, project starts in 6 months time, it didn't start from year 0. Okay, that's why now calculate for the first 3 years how much you are going to receive the income. 1.5 billion, 1.5 billion, 1.5 billion. 1.5 billion means 1500. Okay, you are writing millions. Now the forward rate which you have calculated for the 3 years, what are those rates? Only for 1 2 3 you need. For year 0, that means for half year you don't need. So you are using this rate, you are using this rate, you are using this rate. Okay, and then you are getting converted using the forward rate, the income which you got, convert it. Okay, that means 1500 divided by 144.6, you are getting the income 10.37 million. And then what? Discount factor is 12%. Already it has been given to you as 12%. So using that discount, add all, this will be your total present value. It is in euro. Okay, it is not enough, by the way. Why? You have just got your income. What about your cost? Only in total present value you got. You didn't get net present value. You have to, what about your investment? You have to deduct that. Okay, investment is in year 0. So the problem again comes here. Now, expected spot rate using purchasing power parity. Nice question. Why is expected spot rate in 12 months time using purchasing power parity and forward rate was using interest rate parity? Why cannot we use interest rate parity here? Okay, so the reason I'm giving you is because when forward is there, okay, the formula, look at the formula for interest rate parity. We'll go to interest rate parity first. You need to be very clear with your concepts. Okay, interest rate parity. Where is it? Yes, this one. So here the formula is forward and spot. So that means if you have the interest rate and you have the spot forward, you can calculate, right? That means basically the expected spot rate. But Here what you are doing is just check this expected spot rate. You are not calculating forward rate. You cannot use interest rate also. You have to use inflation rate to calculate spot rate. Why spot rate? Because your investment, what you do in year zero, it is in the spot rate. It is not in the future. It is not in the forward rate you are using. You're not calculating for future. You're going backwards and you want to calculate in year six for the 6 months. You want to calculate the 6 months spot rate. For that, you have to go back. So for that, you have to use this only purchasing power parity. You cannot use the interest rate parity. Interest rate parity is for calculating forward rates. This one is calculating for spot rate, estimated spot rate. First, you have to calculate for 12 months time, then only you can go back to 6 months time. That's why this is little too much of work to do here. And here, you have to use inflation, no interest. This time you have to use inflation. That's why inflation is also given to you in that question. Now you see how the examiner can confuse you. He has given you inflation also. He has given you the interest also. Now you will get confused what to use. Some of you might have used purchasing power parity there to calculate what forward rate. How can you calculate forward rate using purchasing power parity when here itself in the formula forward is not given to you? You can only use interest rate parity. You cannot use purchasing power parity. Purchasing power parity you can use when you have to calculate spot rate. Today you learn this. Tomorrow you will be able to apply this in this next question you do. Now, spot rate, right? So forward rate we have used this, and here we have used 128. Remember 116 and 128. That was the receipt. Now we have to go for the payment. So for payment it will be 116, not 128. Okay, when your payment and receipt, okay, when it's a receipt it's a different rate. When it's a payment the rate changes. You cannot use 128 128 here. So it's 116 into this is 9.7, this is 1.2%. We'll go and check the inflation. Okay, go and check the inflation. Yes, so Mazabia's inflation is 9.7%, right? Mazabia is the foreign currency, so 9.7% in the numerator. Then comes Casasophia, it is 1.2%. Now you see what happens when you're given too much of information and then you become and you just get confused. It's very easy to get confused in such questions. Okay, so now the only difference is this is spot rate, this is inflation, that's it. And this is a payment also, it's not a receipt. So this, and now this is for 1 year. You have to take for 6 months. So in 6 months expected spot rate, same way how we take for the forward, 116 plus this minus 116 divided by 2. So this, of course, it will be less than 1 year spot rate. It's easy to see whether it's correct or not. Technically it's correct or not. Numbers, it might be wrong. So now the total investment required in euro. What was the total investment? How much deposit you have to make? The deposit which you have to make in Mazabia is your initial investment. See, they will not give you everything directly. Initial investment you're investing. This is the trick. This is the catch. Understand through the words. Every case study is different. The way they say mention about initial investment is different. Here they didn't say initial investment. Here they just told Mazabia's government requires Casasophia to deposit 2.64 billion. So that requires means Casasophia has to pay. Right? So that 2.64 itself is the initial investment. Now, where are we? Yes, so that 2.64 divided by this, you are getting your total investment. 21.84. Okay, so now minus it from your present value. What was your total present value? 23.17. Okay, 23.17 minus 21.84. It is 1.33 million net present value. It's a positive net present value, right? So we have got that as well. Now the last part comes. Will swap be beneficial? So we are towards the last part of this video. Now, forward rate. Now here another problem comes is when you try to do swap. Usually when a swap question comes, we think that we have to do that table, swap fixed for variable. But here nothing has been mentioned about fixed or variable. How can you do that swap? They just told will swap be beneficial? Okay. Now, forward rate based on interest rate parity shows this MSC is depreciating against euro as interest rates are much higher in Mazapia. How are you saying that interest rate parity is showing that this one is depreciating? Look at the currency. There is a relationship between the interest rate and whether the currency will appreciate or depreciate. There is a relationship. I have told you. When a currency, okay, when a country is having a high interest rate, that currency will depreciate. Here, Mazabia is having 10.8%, which is a higher interest rate. That means Mazabia's currency will depreciate. Higher interest rate means that currency will depreciate, and lower interest rate means that country will appreciate. Okay, so write it down somewhere. Higher interest rate means that currency will depreciate. That's why Mazabia is depreciating. Okay, so through that interest rate. Now, however, even with the depreciating, the project is still worthwhile. Positive net present value, you see. If you see towards all the year, appreciate means what? Sorry, depreciate means what? Right? Your income, just check your income. Reducing and reducing. 9.628, then 7.63, then 6.28. If you're not understanding depreciating and appreciating, just check your discounted cash flow. It is reducing and reducing. That means what? It is not good. Your income is reducing and reducing. Right? But still, with that depreciating, why you are saying depreciation? Because 10.8. So with that depreciating, MSA project is still worthwhile. Even though that income is reducing, still that project is worthwhile because positive net present value. Now, how, just check how they are using different paragraphs for different meaning. Here they have talked about interest rate parity. Here they're talking about purchasing power parity in the second paragraph. Always keep one line gap, go to next paragraph and talk. And it's here it is 3 lines, here it is 4 lines, here it is just 1 line. Right? It could be one line also. So when forward are estimated using purchasing power parity, basically expected spot rate only. Okay, it is assumed that forward rate will change according to differences between two countries' inflation rates. If Mazabi's inflation is greater than Europeans, MSC will depreciate against euro. Okay, same way, if interest rate is higher, it will depreciate. Even if inflation rate is higher, MSC will depreciate. Same, interest rate higher, depreciates. Inflation rate higher, depreciates. Now, we are told that Mazabi's inflation rate could vary between 5 and from the case study. Right, it could vary between 5 and 15% over the next few years. Therefore, right, that means what? Inflation could vary. That means it could depreciate. It could depreciate further, which is not good. If it keeps on depreciating, okay, a swap would appear to be advantageous as it would fix the future exchange rates. Without the swap, there will be uncertainty over the net present value of the project. Default risk should also be taken into consideration, and Casasophia may ask the government of Mozambique to act as a guarantee in order to reduce the risk. So default risk is possible. This is an international payment and receipt, right? What happened, right? So there's a very high chance of defaulting. So what happens in this case is they can ask the government to guarantee to act as a guarantor in order to reduce the risk. That means the government is going to pay if the company is not able to pay. Now the last paragraph, right? The grant funding will be provided directly to Mazavian government in this. It may be worthwhile for Casasophia to explore the possibility of receiving the grant directly in euro, as this would reduce currency exposure. Right? Isn't it better to receive in your home currency rather than receiving in foreign currency? It will reduce your exposure also. Now let's go to the, so we are done with this question. I know this is very, your head might be gone also by now. Okay, so now let's read. We have net present value, we have, okay, top tips. If you are looking for the strategy that maximizes receipts, if you are faced with a fraction of contract when dealing with options, round down and hedge remainder using forward. Note that future will be closed out before expiry. Okay, either of the two ways given is acceptable. Part B, project is due to start in 6 months time rather than more usual 1 year's time. This means that you have to calculate forward date for 6 months time and go up in increments of 1 year. Easy marks. This is quite challenging question, but you should be asked to able to pick marks for performing forward and future contract calculations and adding comments. So the thing what I want to tell here is whenever you see a question very challenging, right? We don't know what happens in the day of the exam because there is something called luck also. Maybe you have studied something too much, you are very good in something, but that part itself didn't come for the exam. And maybe in some part you are struggling. It's not, I will not be wrong to say that we are never perfect in all the areas. There are some areas where we are expertise at, we are very good. And there are some part we are okay, not that good. And there are some parts which we are very bad at. So it depends also on what type of questions comes, right? So there might be a time that you have been preparing exchange rate, and you think you're expertise, but there are times the challenging question comes, right? You will find questions challenging. You cannot say that there will no, I will not, I will be perfect and I can never go wrong. It never happens like that. So there will be challenging question, but the thing when a challenging question comes, my advice is don't panic. Don't go in that freeze mode. Oh my god, what did I do? What will I do now? I will not be able to answer. What happens is when you go to that freeze mode now, you will not be able to answer anything at all. In fact, you are losing that 25 marks or even 50 marks also. So don't do that. Whatever the easy, there will be some easy marks also in the challenging questions. Like in this forward and futures, you can calculate and comment and get some marks. So try to collect those some marks. See where are the easy marks you can get marks. Maybe the theory is easy. Maybe that theory is not related to the case study. General points you can give. So try to pick up those points. Maybe state some assumptions. So try to get marks like this. Maybe your professional marks is there, right, in a report format. Give advice or based on whatever you calculated, even though it's not perfect. Write assumptions, state assumptions, and then write formulas. So whatever you think, try to manage somehow. You have to do it. Easy marks, you have to try to collect like this. Marks from here, here, everywhere you have to collect marks and keep it in your pocket. That is the strategy, right? Next, coming to the examiner's team comment, this question was not done well. The reason why I'm telling you all this is this question was not done well. And it will not be done well also. If you don't give proper, what do I say, proper guidance is not given for this question, it will be very challenging. In part A, many students presented adequate calculations of cash flow using different derivative data but failed to adverse adequately. For example, options are generally more expensive due to more flexibility. In some cases, students had difficulty in calculating an estimate for basis remaining. So this is also an area where candidates struggle. And occasionally, students try to use money market hedging despite the necessary information not being available in the question. I will tell you why that money market hedging is there. Because of that two interest rate which is given to you, of the Casasophia and the Casasophia. So because whenever see the question, just because two interest rate is given to you does not mean you have to use money market hedging only. There are so many other information which is required, right? You are not being given what is borrowing rate and what is the lending rate. You are just given the interest rate of the two countries. You don't know whether it's borrowing or lending. So how can you use money market hedging? Nothing has been mentioned about money market hedging here. If if there is a money market hedging which you have to use, clearly they will specify. Because we saw option was there, we saw future was there, we saw forward was there. So for money market hedging also, whenever they have to ask you a question on that, remember they will clearly tell or mention about money market hedging. They will just not give you like this, you know, so that you have to assume whether you have to use money market hedging or not. Just because interest rate is given, you don't have to. In such case where nothing has been mentioned, you don't have to write about, you don't have to calculate also, do anything on money market hedging, because already so many option has been given, option, future, forward, swap. So it makes sense that money market hedging they will not ask. So don't do this mistake, because you are calculating money market hedging, wasting a lot of time there while it is not even needed also. Okay, so this is very important for time management also. And few attempts were made to calculate future spot rate based on purchasing power parity for part B, and some also just discounted the project in the local currency rather than in euro. Don't do this, please. I beg you, don't do this. Question specifically asks in euro. So don't discount it in some other currency and find net present value in some other currency only. Now let's go to the marking scheme. Okay. Forward contract 1 mark. Calculation 1 mark, comment 1 mark. Future 3 marks, because of course we have to find basis, rates, closing, future price. A lot of things is in the future. Future contract comment also 2 marks. Option contract calculation is 4 marks. Okay, because that is 2 exercise price, no, that's why. Then comes option contract comments 2 to 3 marks. You see, comment and calculation is 1 mark. So if you leave the comments, 1 mark you are losing here, 2 marks here you are losing here, 3, another 2 to 3, let's say 6, and 1 conclusion. So 7 marks you are losing just if you are not commenting or not concluding anything. Part B, estimate of forward rate, 3 months. Forward rate you have to estimate. Estimate of present value and net present value in euro, again 3 marks. Discussion is 4 to 5 months. My God. You see? So don't do all this mistake. With this, I end this video here and wait till my next video is out. And don't forget to subscribe to my channel. Do take care. Take a very great care of your health. Exams are coming near for March. So I know most of you are preparing for March now. Results are out by now. And best of luck. Take care.